What's up, it's Austin Rutherford and welcome to my channel. The hot topic right now are interest rates and how they're going through the roof. They've actually almost doubled in the last 6 months. And for a lot of people, that's going to be the steepest increase that they have ever seen. So in this video, I'm going to break it down to you and tell you how that will or maybe will not affect you and what rates that you can expect in the future. So let's start by looking at this chart right here. If you were to look at that chart, you can see that in December of 2021, interest rates were right about, for 30-year fixed mortgages, were right around 3%. 6 months later, in May of 2022, interest rates are almost 6%, therefore doubling in about a 6-month period. And there's really no sign of that increase in rates slowing down anytime soon. And if you were to look just at this chart, it's insane, the rate that is going up. What I want to be insane is that like button, smashing the like button. If you could do that for me, it'd be greatly appreciated. But further into this video, I'm gonna break down how this chart is just a small picture of what's really going on and how the interest rate increases, even though they've doubled in the last 6 months, really isn't that high. But what does this actually mean? If you're borrowing money right now, like buying a house, you're really gonna feel the pain of what this increase in interest rates really do. So let's jump into a screen share. I'm gonna show you exactly what this change means if you're out there currently looking for a house. So if you look at this chart here, this is what we use to evaluate rental properties, but I'm just gonna be talking about the mortgage payments right here, the highlighted blue areas. So for an example, let's say you're gonna take a single family house, a $250,000 house with a 20% down payment, so an 80% loan on a 30-year amortization and a 2.8% interest rate, meaning that you would put $50,000 down and you would finance the other 200 grand. So 200 grand at 2.8% on a 30-year AM means that your monthly mortgage payment would be about $821 per month. So the interest rate went from 2.8 to about 6%. So let's see what changes. When all we do is we change that percent for 2.8 to 6, what happens to this monthly mortgage payment right here? It goes from $821 a month to $1,199 per month for the same exact house. That's an almost $400 increase in your mortgage payment for the same exact property. And this doesn't take into account the taxes and the insurance and the other things, but let's say you're looking for a little bit more expensive of a house. Let's say you're looking for $1 million house. So the same thing on $1 million at a 2.8% interest rate would be $3,287 per month. Again, plus taxes, plus insurance, plus that stuff. This is just your principal and interest payment, would be $3,287. But if that 2.8% goes to 6%, that $3,287 goes to $4,796. That's $1,500 per month more that you would have to pay for the same exact property. So what does this actually mean? If you're currently out there looking to buy a house, it just got more expensive for you. If you already have a house that you're comfortable with and you're happy with you and your family, then you're good to go. You don't have anything to worry about because most likely you have a fixed interest rate that will not change, so your mortgage payment will stay the same. But if you're out there shopping, you have two options. You either need to look for a smaller house because you can afford less house now, less price, or you need to increase your budget for the same exact house. But the bigger thing that I'm worried about here is the economics behind this. You see, people have two types of money, is living money and disposable income, right? So you need to live, right? You need a house over your head, you need food, you need shelter, you gotta take care of your kids, whatever that is. You have those expenses that have to be paid every single month. And the money left over after that is your disposable income. That disposable income is for you to go out and hang with friends, for you to go out and travel a little bit, for you to go out and buy those nice things that you wanted, the TVs or the cars or the houses or whatever that is. The disposable income is that extra income. So we just broke down how it would be more expensive for the things that we need, i.e. a house, meaning that you have to pay more money for that, meaning you would have less disposable income. So when you have less disposable income, people start spending less money. When people stop spending as much money, then income for businesses go down. When income for businesses go down, people tend to start selling stocks. When people tend to start selling stocks, it's a snowball effect for more people to continue to start selling stocks and the market continues in a downward motion. And then after that, when these businesses don't have enough income coming in, people spending money, guess what? They don't need as many people to work. They can't afford to pay as many people a salary. So guess what happens? Some people start to get laid off from work, which continues the downward snowball effect because if people are getting laid off, there's less disposable income, so less money is being spent, and it's the same thing that just continues to happen time and time again. But the good thing in all of this, remember when I showed you this chart here, how it looked like the interest rates were insane? How about we check out this chart here now? You can see that we're still at a very, very low interest rate compared to what we did in the 1980s, the 1990s, the 2000s. We're still very, very low on the interest side. We just got so spoiled with these ultra low rates. If you look at the chart, in 1980, the interest rate was 18%. I remember my dad told me when he bought his first house many, many years ago, he was paying 15% interest to buy that property, which is crazy for me to even think about right now, that you can't even afford like any house because the interest rate would be so high. So in my opinion, all in all, with the interest rates going from like 3 to 6%, which again, isn't that high in the whole scheme of things, you know, adding a few $100s a month to people's expenses, it's not good, it's not ideal, but I don't think it's the end of the world. I don't think this leads to like a massive, massive market crash and everything explodes. Now, if interest rates continue to skyrocket and get to double digits, you know, 10, 12% interest, then yes, I think that'll have a serious effect on the economy because people are gonna be able to afford significantly less than what they can now, meaning that they're gonna stop spending as much money, meaning that businesses are gonna make less income, stocks are gonna go down, people are gonna get laid off, and it's that snowball effect that we talked about earlier. So long story short, if you're freaking out about this increase in interest rates, it's okay for right now. It's 5 to 6% interest. If you look back, in 2000s, we were literally just at 5 to 6% interest, you know, just a few years ago. So it's not like the world is ending. You know, we just got spoiled over the last 3 to 4 years to expect 2 and 3% interest rates. So all in all, unless you're currently out there house shopping, like me, unfortunately, you don't really have anything to worry about yet. Again, if interest rates continue to increase, that can be a snowball effect into a lot of other things. So if you're shopping for a house, I would just like to say I'm sorry, but I feel your pain as well. So comment below, let me know what you took away from this. If you have any questions about interest rates, make sure you smash that like button for the YouTube algorithm as well, and hit that subscribe and notification bell so you can get all this content going forward. As always, appreciate you being here. We'll see you on the next one.